You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Okay, let's jump right into it today. We're looking at this interplay, really, between central bank policies, global trade efforts, and that ever-present geopolitical risk.
Yeah, it's a critical time to connect these dots. We're essentially looking at how a strong dollar, cautious commodity markets, and some complex trade talks are, well, painting the current global picture for you.
You miss one piece, you kind of miss the whole story.
Exactly.
All right, let's start with the biggest driver right now, policy divergence. I mean, the U.S. dollar is just undeniably firm.
It really is. And it's a direct result of that hawkish Fed messaging we keep hearing, even when the U.S. data itself is, well, a bit quiet.
But resilient, right. And you see it in the pairs. Euro USD, for instance, stuck below 1.1 cent.
Right. That 1.16 level is, it's acting like a real line in the sand. It signals that gap in confidence, tighter U.S. conditions just pull capital in.
And that strong dollar has knock-on effects everywhere, especially emerging markets.
Oh, absolutely.
Yeah.
Especially those with dollar debt. But the contrast is where it gets interesting. Look at Japan.
Yeah, the yen keeps drifting weaker.
Even with hotter Tokyo CPI, you'd think that might trigger something from the Bank of Japan.
But nothing. No fresh hawkish signals at all.
And it makes that jawboning, the finance minister talking about rapid moves, it makes it look pretty ineffective.
It just failed to turn the tide, didn't it?
Completely. Shows the market believes the BOJ's policy stance more than the verbal threats. That's significant.
Okay, and let's not forget the UK. Sterling's been a bit soft, but seems steady for now.
Yeah, a slight recovery. Still some background noise from UK fiscal headlines, but generally holding its ground after a rough patch.
Now, connecting policy to trade health. China looms large here. Those commodity currencies, the Aussies and Kiwis.
They're heavy, and it's no surprise why. China's official manufacturing PMI, it slid further into contraction.
Oof, that sends a chill through anything linked to Chinese demand, doesn't it?
Instantly. When China's manufacturing contracts, you just have to be cautious about those exposed currencies. It shows how quickly local data, PMIs, CPIs, translate globally.
Deeply intertwined paths. So, strong dollar, yes, but colliding with these real concerns about global growth, especially out of China. Which makes trade diplomacy, our next topic, so vital.
Right, let's shift gears to those diplomatic efforts. You see high-level calls for cooperation, like President Xi at APEC talking about safeguarding trade, smoother supply chains, greener standards.
That's the aspirational stuff. But then, almost in the same breath,
You get South Korea flagging, a deepening period of global trade uncertainty.
So the talk is cooperation, but the feeling on the ground is more fragile.
Precisely. And that fragility forces more coordination attempts. Look at the EU, and U.S. Brussels is prepping for talks later this month with the Commerce Secretary.
And industrial policy coordination is right at the top of the agenda.
Yeah, trying to align those massive systems, green tech goals, subsidies, it's complex, trying to avoid trade friction.
And regionally too, right? Japan and China.
Also critical. Tokyo signaled it wants to clarify things with Beijing, stabilize the relationship. That's huge for tech supply chains running through Asia.
So if you step back,
You see this constant push and pull, high-level calls for smooth trade, but underneath there's this structural uncertainty, this need for stabilization, particularly between key Asian players.
which leads us nicely into commodities. They seem to be, well, waiting.
Biding their time is a good way to put it. They're looking for clearer signals.
Take crude oil. Pretty range-bound.
Yeah, the market's just marking time before the OPEC Plus meeting this weekend. The base case expectation is only a modest supply adjustment.
So no big volatility baked in ahead of that.
Not really. Seems positioned quite neutrally, expecting more of the same rather than a major shock.
And gold.
Kind of oscillating around that $4,000 an ounce mark. Its daily moves are really just tracking the dollar and yields very closely.
Still driven by those external factors, Fed hawkishness versus safe haven demand.
Exactly, and that immediate reaction we saw with the commodity currencies. Even sharper in base metals after that China PMI miss.
Right. So metals are softer?
Definitely. Copper, especially. It tried to firm up overnight, but slipped right back into its recent range.
Copper being that bellwether for industrial health.
Precisely. Bad manufacturing numbers out of China translate almost instantly into lower expected demand for copper. It's a very clear link.
It really shows how sensitive commodities are. Their quiet state isn't calm, it's anticipation. Holding their breath before OPEC plus I, or reacting instantly to big data like China's PMI.
Okay, final piece of this puzzle. Geopolitics. That underlying risk premium, even when it feels like background noise, it's there and it costs.
That sort of steady hum of event risk, like Israeli operations near Khan Yunis.
Keeps that Middle East risk premium firmly in view. It doesn't just vanish because we get used to the headlines, does it? It affects energy transit, insurance.
And the diplomatic freeze involving Russia and Ukraine, that canceled meeting.
Yeah, Washington calling off that planned meeting over what they called maximalist Russian demands. It was brief, but it injected uncertainty. Shows how quickly diplomacy can stall.
Raises the specter of, renewed tensions or tougher sanctions. Always impacts capital flows, especially in Europe.
Then moving over to the Americas. Venezuela.
Right. Reports of potential U.S. target sets linked to narco-trafficking if Washington decides to escalate pressure.
It's a clear signal of potential intervention. If that happens, it could disrupt regional stability, maybe impact oil infrastructure very quickly.
And then there's the Indo-Pacific. A real mix there.
A fascinating dynamic. You had the U.S. Defense Secretary meeting his Chinese counterpart described as constructive, which is good for calming nerves.
Aye.
But almost immediately, Washington reiterated strong concerns about South China Sea activity.
So dialogue helps, but the core flashpoints, those maritime issues, they're not resolved at all.
No. And that defines the global outlook, really, this balance. Trying to talk, trying to keep things stable, but with these major underlying disputes simmering away.
Disputes that could easily disrupt vital shipping lanes.
And this raises that important point about the risk premium. It's not abstract. It means real cost, higher insurance, maybe less efficient supply chains as companies diversify, capital being more cautious about certain regions.
Okay, so let's try and synthesize this for everyone. We've got a strong dollar driven by policy divergence pressuring EMs, steering gold.
We have commodities largely waiting for OPEC plus a dove for China data clarity.
Trade diplomacy is in this constant battle trying to smooth things over amidst structural uncertainty.
And right now, the market is laser-focused on FX reactions to any China data, and any whispers coming out ahead of that OPEC Plus meeting, those offer the most immediate clues.
But here's the final thought for you. Think about how quickly one of those background geopolitical factors could flare up. Venezuela, the South China Sea.
Right, things that feel peripheral right now.
If that diplomatic effort, that careful balancing act we talked about, if that breaks down,
those risks could suddenly become front and center. They could easily destabilize that commodity quietness, that equilibrium the market's found.
And erase that cautious stability pretty quickly. That's the edge, understanding how those background risks could suddenly roar back.
Stay informed, stay adaptable.
We'll catch you on the next deep dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.